believe that markets are driven basically by fear and greed. And with fear and greed, you get extremes in the markets. And what the tendency is then, you get stock prices that will either go to very expensive or very cheap at times. And as a value manager globally, we're looking for the extreme of very cheap stock prices. We look to find good, high-quality businesses at times when the markets are fixated on short-term problems, and we keep our eye on the long-term business values. And where we see a large discrepancy in those areas, that's where we look to invest our investors' money.
We are not looking to invest to build portfolios that trade on low multiples. We're looking to invest in good companies that are mispriced, that are trading at a discount to their intrinsic or fundamental value.
So we want to first look for companies that are cheap relative to their own history, relative to their own country, that are and relative to their own sector. So we make sure that we're buying something that's selling for less than normal on a stock-by-stock basis. Then the next step is we want to make sure that we're buying good businesses that have no obvious barriers to success. Then the combination of factors is really important, because we just don't want to buy things that are cheap. If you sent someone out with the only instruction is, hey, go buy me some cheap stuff, what would you get? You wouldn't be happy with it. You have to say, well, I want quality companies. I want companies that have significant long-term growth potential. So you have to combine other factors of the businesses, and that's where we use the combination of quality, growth, timing, because you want to buy things at the right time. You don't want to catch a falling knife and be too early. But you also want to buy them at a great price with significant room for valuation, to increase valuation. Then we also want to make sure that we're diversified by country and sector to enhance the probability of outperformance.
We invest across market capitalizations, as in large, mid, and small. As you know, small and mid-capitalized companies are less owned, less followed, and often misunderstood, again, creating for misvaluation opportunities. First and foremost is the team, the investment team. It is a small team, consists of 8 investment professionals with a long track record that goes back well over 20 years and a very healthy longevity and stability, with the core 5 out of 8 have been working together as a team over 10 years.
We don't start with a macro forecast in building the portfolios. We start from a bottom-up perspective, so we're looking at individual companies. However, when we do look at these companies, we're aware that oftentimes stocks are driven down because of macro factors. So we need to be aware of what's happening in the world around us as we're investing. We think that that is critical, but it doesn't drive us to necessarily invest in any one particular company.
We do believe that we're going to be wrong sometimes, so we want to make sure that the portfolio's performance isn't about one thing. So we take this basket of securities, great companies with tremendous quality and growth potential, selling for less than normal, and we want to make sure that we get those factors and get that exposure from as many places as possible.
You don't make better decisions by surrounding yourself with people that agree with you. You only improve your decisions through seeing things through the eyes, the prisms of other people's other perspectives. So effectively, having 3 people that follow, that believe in the same investing philosophy, but with different perspectives, different minds, different backgrounds, looking at the same task in a different way, makes for better decisions over time.